Hi, my name is Roy Rumbo. I am an adjunct professor at the University of North Texas in Denton, Texas, and I teach Intermediate Accounting 1 and Intermediate Accounting 2. Today's lecture is about the income statement for my Intermediate Accounting 1 class. I'm going to give credit right off the bat here to McGraw-Hill. The source of my materials today is McGraw-Hill textbook, the Spiceland, Nelson, and Thomas book called Intermediate Accounting. It's a great textbook. Highly recommend it. And with that, I'm going to get started. Let me share my screen and we'll get right into the income statement. All right, here we go. Let me move my face up a little bit there. All right. Okay. Yes. So the first two chapters, first two lectures for Intermediate Accounting 1, we talked a lot about measuring, journal entries, debits and credits, and how to do closing and adjusting entries to make sure that we got everything captured in the accounting close process. And why are we doing all of that? We're doing all this measuring with debits and credits and journal entries and all this work for one purpose, and that's the report. How do we report? We report through financial statements. Chapter 3, we talked about the balance sheet, and the balance sheet answers the question, what is the financial status of the company? What are all the things that the company owns, which we call assets? And what are all the claims against those assets? That includes debt and shareholders' equity. Now, in that chapter, we talked a lot about liquidity and the importance of liquidity. And, if the company has significant amounts of debt, boy, that could be an issue for the future viability of the company. And so the balance sheet answers that question around what is the financial status of the company. But now we move to the next chapter. And everybody is a lot more interested in the income statement. Why? It tells us, is the company making money? And if you want to invest in a company or maybe even work at a company, you want to make sure, hey, that's a profitable company. If a company's making a lot of money for employees, that means a company has better capability of raises, annual increases in pay, maybe promotions. If it's really a fast growing company, there may be a lot of opportunity with this company. And so the income statement is going to answer that question. Not only is the company making money, but how is the company making money? So we're going to have some classifications that we can understand more about the income stream of the company. So with that, let's get started and we'll go right to the first slide. So, and we're going to talk also about the statement of comprehensive income and the statement of cash flows in this chapter, but obviously the income statement's going to take a big piece of this, and it reports the company's profit. Now, there are some gains and losses that under generally accepted accounting rules do not go straight to the income statement. They get captured in equity in something we call a comprehensive income. A little bit beyond the scope of this Intermediate 1 course. We may touch upon this later with some things, but there's some areas where we want to get the balance sheet correct, but the change in the balance sheet, the GAAP rules may not want us to record those things on the income statement. There's various rules that come into play, and that if we did report those in the income statement, it might be misleading or might overshadow the profits of the company. So we put these items in equity, but in comprehensive income. And finally, one of my favorite statements is the statement of cash flows. It ties closely together with the income statement because it is all three of these statements are basically flow statements that capture, all a flow of transactions, not the balance sheet with a point in time, assets and liabilities. These are around flows, revenues and expenses and flows. The statement of cash flows, as I talked about flows there, talks about all the cash in and cash out, and we segregate cash into various in operating, investing, and financing activities, and we'll take a look at that. I will say all of these statements together, they're going to tell a story about the company. And when you understand the story that the numbers tell, hopefully it's the truth. Hopefully it is a faithful representation from chapter 1 of the real status and the profitability of the company. Hopefully the information you see is relevant to whatever decision you might make from reading those statements. But these statements together will tell a story. And so let's go straight to the income statement. And here's McAllister's manufacturing and income statement. And I like the way the textbook slide here is broken the income statement into 3 different areas. And we'll further break these down when we get into the income from continuing operations further. That mouse is a little too sensitive there. So the first section is income from continuing operations, and contrast that with discontinued operations. So there may be some areas of the business that are not going to continue to be part of the business in the future. Either, we could liquidate it, but more likely it's areas of the business that we're going to sell off. So maybe a large multinational corporation is going to sell off one of their business segments. Generally they may want to do that because it's not profitable or doesn't meet their strategies anymore, but it's not going to continue in the future. However, there has been income or losses related to that business in the current accounting period. And so we separate that out because in reality, people don't care about that anymore. What they care about is the future. If people are trying to invest, what does this company going to look like in the future? So therefore, we segregate our profitability, our income statement between operations, the profitability of operations are going to continue, and operations that are not going to continue, they're going to be discontinued. Finally, the last section of the income statement is the earnings per share calculation. We'll talk about a lot of ratios in intermediate accounting and even later in advanced accounting in your finance courses, but there's only one ratio that ends up right on the face of the income statement, and that is called earnings per share. And so, for example, this company made income from continuing operations of 111.3 million. And we take that and divide it by the shares outstanding, and we look at this company as making $2.14 from per share for continuing operations. And we do calculate this both for continuing and discontinued in total. So what's great about earnings per share? Now we can compare earnings per share to the price per share. And so if we can see the price per share on the stock market, we can divide that price by share divided by the earnings per share. And that would be what we call a price multiple, which gets back to valuation. So a very expensive stock would have a very high multiple, and a cheaper stock would have a low multiple. So that's how we know if stocks are expensive or cheap. That's also called the PE ratio, or the price to earnings ratio. We do calculate earnings per share on both in a basic and a diluted calculation. And we'll get into that later, but diluted includes more shares than the basic calculation. Okay, so what's on the income statement? Revenues and expenses, right? That's basically it. Now we're going to classify these in different categories, but we've got revenues that are positive numbers that are benefiting owners, right? Owners want you to sell more. So revenues come from selling our products or our services. So if we are a successful business, we're going to be selling a lot at the highest prices, hopefully very high prices, for owners. And that's where income comes from selling stuff, products or services, and we call those revenues. Now, to sell those products or services, we're going to incur some cost. It could be salary expense, it could be materials, supplies, interest expense, right? And we're going to have income tax expense. So there's a lot of expenses offsetting those revenues. And obviously, if revenues are higher, what we're selling is higher than what it's costing us to sell those things, that means we're profitable. So revenues, minus expenses ultimately equals net income. That sounds easy, but it's going to be a little more complicated as we get into that. And the first thing is recognition. How do we recognize expenses? And there's two kind of ways here, if you will. One, is it possible to establish a causal relationship between the revenues and expenses? I think the easiest one to think of is selling a product. Let's say you go to Home Depot and you buy a washing machine from Home Depot. Yeah, so that washing machine is a revenue. When we take it out of the store, that's a revenue transaction for Home Depot. Well, what's the cost? Direct cost. They had to buy that washing machine from one of the appliance manufacturers. And so revenue minus the cost of goods sold. Cost of goods sold would be the cost that Home Depot paid for that washing machine. And that's a direct causal relationship. There could be other expenses that may not be as directly related to the revenue, more indirectly related. Let's just think about the rent for the Home Depot store. So they're renting that, maybe usually retail, they're renting over 10, 20-year period, they're renting that. And so that expense can be allocated over those 20 years. What if they just bought the land in the Home Depot building and they're going to keep that building for 20 years? Then they're going to use depreciation expense and allocate that expense over the 20 years. Would they have been able to sell that product if they didn't have a store? No, not in Home Depot situation. And so the benefit of using that store gets expensed in the right accounting period. There are other things that are going to happen outside of the normal operations. We call these they're peripheral or incidental transactions, and they could be gains and losses. For example, if the company is not a real estate company, but they happen to sell a piece of land or building that they no longer needed, they may have a gain or loss on selling that building. So it is not part of the gains and losses are generally not part of the normal operations. Therefore, we're going to put them in a little separate place on the income statement, and we will see that. And here we go. We're going to see it right now. So here is this is an income statement. Income from continuing operations is all we're looking at. Look how it's divided into three areas. Operating areas, these are all the things related to operating our business, the cost of the products sold, selling, general administrative, maybe some R&D for future. We're going to get into restructure costs, but these are all costs, revenues and costs of operating a business. We have a special term there, a subtotal called operating income. And so that's plus all the revenues minus all the expenses from just operating our business. And then below operating income, we're going to put these non-operating items. We talked about gain or loss in the sale of investments, but then interest income and interest expense will show up here as well. That's non-operating areas. And so it's below operating income. And why do we have an operating income subtotal? Because people looking at the income statement want to understand, hey, how much money are you making from just operating your business? You can look at that in the operating income. These other things still matter because they could be gains or losses for shareholders, gains being credits, good for owner's equity, losses being debits or deductions from owner's equity and deduction from operating income. So we have another subtotal here, income from continuing operations before income taxes, 171.2 million here. In the final section of our income statement, we're going to come in and have the income tax expense related to that. So we have income before taxes, and then later income, I say after taxes, but income from continuing operations. So you can see how income from continuing operations is broken up into three areas here. I will note there's another subtotal here called gross profit that really matters because that is just the revenues from products we sold minus the cost of those products. It could be services too, revenue from services minus the cost of the service. So that gross profit is related to things that are directly related to the sale of products. And here's an example from Home Depot where their operating income, and these are in millions. So this is, they had $94.6 billion in revenues in the year ended in 2017. 32.3 billion in gross profit. Looks like about, a 30 to 33% level, maybe a little bit higher than that. And operating income was 13 billion on 94 billion of sales. That's awesome. And they got some interest income, some interest expense that's a little bit higher there. Income before taxes, and look at that. Income tax expense, 4.5 billion. That's a big number. That's why Congress looks at corporate income taxes. And it's a great way to collect taxes, but they also want to motivate businesses to do business in the United States. So it's a challenge to keep it low enough for people to be successfully doing business, yet high enough to collect taxes to pay for all the services that we need. We have two types of income statements. We'll say a single step and a multi-step. In a single step, we just combine all the revenues in one places and all the expenses in another place. And look what you miss here. You miss the operating income, you miss the gross profit, the operating income, and so you miss some subtotals that might be meaningful. Therefore, personally, not a big fan of the multi-step income statement, of the single step. I like the multi-step because I want to see that gross profit. Now I can do some math. So I could take gross profit divided by sales revenue, and I can understand their gross profit percentage. I can compare that percentage to another company, maybe the industry, maybe to all companies, right? And so that gives me some information that's really important. And then I get to look also, here's a second subtotal, operating income. As we said, that's the income from just operating our business. That did not exist in the single step, but here in the multi-step, I can see that more clearly. And then finally, we get down to the same line items as before. So again, a multi-step income statement is easier to read, more useful, and I think you'll see that in more companies than not. Well, earnings quality. Well, earnings quality gets to, back to the users of the financial statement. And for most of the users of the financial statement, they don't really care about the past. They want to know, how is this company going to perform in the future? Because if I'm making a decision to invest, if I'm making a decision to work for the company, all these decisions are not about what happened in the past. It's, if I'm investing in the company, I hope they're going to make more money in the future. And I'm looking at the historical financial statements, looking at the past and trying to predict the future. Well, inside these earnings the same thing, by the way, another term for income, net income or profitability, we've got some earnings that are temporary. They're probably, and they could be expenses as well, things that are not going to reoccur in the future. And there's other earnings that are permanent that are going to continue in the future. And if we look at income from continuing operations, we assume that's more permanent. It's going to continue to be like that in the future. Although there's some unusual line items even inside income from continuing operations. And so when we look at our income statement, and as preparers of the income statement, we want to make sure we use some useful line items that help people to understand and identify temporary versus permanent earnings. And we're going to look at some examples here of temporary versus permanent income. The first one is restructuring costs. And this is very important. And you see this line item on a lot of income statements. And in the companies I work for, we did classify quite a few things as restructuring. And so restructuring costs are special costs, usually unique, like one-time type costs. They're not going to recur in the future. About, restructuring the business, what we'll say, but something's changing about the scope of the operations. And we recognize those costs when these restructurings happen. I have so many examples, so I won't bore you with all of them. But I think back to my Maytag days, and we closed a lot of factories. And so we had a very large factory in Galesburg, Illinois, and we decided to produce that refrigeration in Mexico. I mean, that's when you see a lot of manufacturing moving out of the United States back in those days. Hopefully some of it's starting to come back now, because I'd much rather see companies manufacturing in the United States and improving our economy. But, companies got to make good business decisions, and they want to manufacture where it's cheaper to manufacture. Closing that factory down in Galesburg, Illinois was about an $80 million cost, because we had a lot of significant kind of costs with severance for the people. It's a really big factory. Worked at that factory. We had to close the factory down. By the way, we'll see this later in chapter 11, I think it is, we had to write down the factory because it had no more value to us. And, let's say we had, I don't know how much was on the books back then, 10 or $20 million, book value. We had to write that off because it was now worth zero to us. And so there were some big charges, but they were considered kind of one-time charges, because you can only close the Galesburg factory one time. It's not going to close in the future. So all of those costs with closing Galesburg out got put in one line item on our financial statements, on our income statement. It said restructuring costs. And so you see here, and we had termination benefits to all this out by union contract. We had to, have a special payment. We had to pay all the employees because they were no longer going to work for Maytag. And so restructuring is usually about an exit activity. You're exiting some activity, whether it's manufacturing a location or maybe a business or a warehouse. You're closing it down. You're not going to do business there anymore. And all those costs are considered, back to this slide here, those were temporary costs. They were one-time costs. They weren't part of our permanent earnings stream. So we separated out in restructuring. And you'll see later when we talk about non-GAAP earnings, one of the things that gets added back in what's called non-GAAP is restructuring costs. So that we'll talk about that here in a minute. There could be some non-operating things that we might want to look at, and that's below. That's why operating income as a subtotal is so important. Some of these interest income or interest expense or gain or loss on sale of investments below operating income, they may or may not occur in the future. And so that may be there, and they're referred to as non-operating items. Hey, here we go. It's right in front of it. I should put this slide earlier than that last slide. So this is a very controversial area because, everything that we talk about in this course is GAAP. Everything should be recorded in generally accepted accounting principles. However, a lot of companies are, providing a second number. They have to, by law, have to provide the GAAP earnings with the same prominence as non-GAAP. But what some companies will come back and do is add back, like, okay, if we did not have this restructuring cost, that's usually the one thing that gets added back, our earnings would have been higher, would have been this amount. And usually companies will show non-GAAP operating income, non-GAAP net income, and non-GAAP earnings per share. And so if we did not have this restructuring cost, which was a temporary one-time item, our earnings per share would have been higher. So why is it controversial? They're probably trying to convince investors, don't look at this, don't look at this GAAP earnings, look at this higher non-GAAP earnings. In many cases, the non-GAAP earnings are higher. Sometimes they could be lower, but generally they may be higher. Some companies, including some I work for, may have had a net loss, meaning especially we took an $80 million charge on that Galesburg closure, that might have taken us to a net loss. And so you say, hey, yeah, we have a net loss in GAAP. However, I'm going to add back this 80 million. Say, yeah, we made money. We really made money on a non-GAAP basis. And so by disclosing these amounts, both in GAAP and non-GAAP, investors have a choice whether they will accept, yeah, let's add back that restructuring cost. And let's look at the company as if that restructuring cost was not going to recur again in the future. I would ask you to have a skeptical eye, because if companies have recorded $40, $50 million restructuring 3 years in a row, they might continue to have more restructuring costs in the future. So you want to be cautious there. And then another obvious temporary item, and this is more clear, and this is GAAP. Now, this is not a non-GAAP item. Discontinued operations. If the company has decided to sell or dispose of a significant component of their business, that means those profits are definitely not going to continue, and that is required by GAAP. Record that in a separate, as we saw earlier, a separate section of our income statement. And so we'll have income from continuing, and then income or loss from discontinued. Why do a lot of times you see loss from discontinued? Well, think about it. If they weren't going to sell it, why are they selling it? If it was making a lot of money, they probably would keep it and it would continue. But when they had to make the hard choice to discontinue, dispose of a component of their business, usually because they had losses. So a lot of times you see loss from discontinued operations. Now, sometimes we might sell it before the end of the reporting period. And this is important to note. Certainly you'll be tested on this. There's usually two pieces of that. One, is all the revenues and expenses, the income or loss that happen inside that, separately inside that discontinued operation. But we also could have a gain or loss on the sale of that business. And so both of those items get included down in the discontinued operations. So this is, a lot of times we say this is about geography on the income statement. Geography, where do I put the gain or loss on the sale of a discontinued operations? Where's the geography on the income statement? It is in the geography in the discontinued operations section. So if you had a big loss on that, it makes sense, right? You wouldn't want to put that loss up in continuing operations, because that loss is not going to continue in the next year. It's a one-time deal. So it would be in your discontinued operation segment. Here's an example from discontinued operations. So the Duluth Holding Company decided to sell one of its division, and the division was sold on December 18th. They had already a loss of $5 million, from just running the business. That discontinued business had a $5 million loss, but guess what? It sold it for $15 million, and the net book value is only $12 million, so they had a gain there. So that -5 + 3, we're going to have a $2 million loss from discontinued operation. By the way, and I should have said this earlier, you do have separate tax calculations. You'll have income tax expense on your continued operations, and separately you'll have income tax expense, or this is a benefit because it was a loss on your discontinued. Why would that be important? Well, you could have different tax rates, different tax jurisdictions. If you sold a business in China or Australia, there might be a different tax rate there than the rest of our business, which might be in the United States. And so we record those taxes differently. And we place them in the geography of the income statement. The income tax expense or benefit, meaning credit to taxes, gets recorded where the tax was related to, whether it was continued or discontinued. Now, if the business has not been sold, what can happen? It might be impaired. In other words, if we know that we're going to sell a business at a loss, and we cross over a year in, we have to write the business down. So we'll take what's called an impairment loss, and we'll talk about that later. It's the kind of projected loss that we're going to incur when we sell it. By the way, you don't get to write it up. You only have to write it. You only get to write it down. So you cannot have like an impairment gain. It's impairment losses only. And that impairment loss also gets recorded in discontinued operations. You do not put that up in the continuing operations. I'm not going to work through that example. And so I'm just going to go back real briefly here. Go back here to this line item. I'm going to go back all the way here. Again, if we go back to this slide, when I'm talking about geography, where a revenue or an expense is recorded, okay, is it in the continuing operations? And so the things related to continuing operations, they get recorded here in the continuing operations. And note here, and this example of the McAllisters, they had restructuring costs inside one of their continuing operations. So there were some kind of smaller exit activities, maybe closing down a factory or closing a warehouse or whatever, or getting out of a state, who knows what's going on. But that's still restructuring costs. It's still considered part of continuing operations. Only when you sell an entire business, a big segment of your business, does it get put in discontinued operations. And so when we think about geography, things related to discontinued operations, whether it's a gain or loss in the sale, the revenues, expenses from that business, or an impairment loss, they all come in here. So that net income is influenced by the things that are only related to the discontinued operations. And you keep income from continuing operations clean. Very important, right? Because investors care more about what's going to continue in the future. They're going to say, hey, if I made 111.3 million in continuing operations, then I know next year I'll probably have a chance of making that 111 million again. But this 105 is not going to, I mean, this loss is a $5.6 million loss. That's not going to continue to next year. So I don't worry about that. I'm going to worry about the 111, not the 105. All right, let's get back to where we were. I just want to, I think that you don't see the term, the income statement geography in this textbook. That's much more from the world I came from. Now, we're going to have along the way, now we're switching gears from the income statement, by the way. We're going to talk about accounting changes. And so we could have a change in accounting principle, a change in an estimate or reporting entry, or we might have to correct an error. Maybe there was an error in last year's financial statements. We got to understand, how do we account for these accounting changes in a way that is going to be useful for investors? And I'm going to come right back down to here, to these three. There's three possible approaches that we can handle for accounting principle. This is the main section of this slide. And there's only two that I want you to think about. One is the retrospective approach. That means I go back, the SEC, public companies, most companies, even private companies, when they provide an income statement, they'll provide 3 years worth of income statements. So I can compare this year, the last year, to 2 years ago. So I can understand trends. In the retrospective approach, I change all of those years. So let's say I find an error that happened 3 years ago. I will go change that year, 3 years ago, and I will change retained earnings then in year 2 and then in the current year. And so that's retrospective. I change all the prior year's information. There's another approach that I only change it prospectively after I found it. Now, just so you know, an error, always you require retrospective. I go back and what's called restate prior year's income statements. And change in an estimate. Let's say 3 years ago, we thought a piece of equipment was going to last 10 years. And we were expensing it over what we projected to be 10 years. Now, this year, we realized, oh man, thing's only going to last 7 years. So that's what's called a change in an estimate. We had an estimate of 10 years. Now we're estimating it's only going to last 7 years. Well, and for a change in an estimate, it's different than an error. We only change this year's number going forward. We do not go back and change prior year income statements. So generally, where you'll see this is like I just talked about my example. If we change, if we have a change in depreciation, we'll account for that on a prospective manner. So this slide is basically what I just talked about. A correction of an error, if we find it in the same year, we just reverse it and correct it. But if it was found from a previous year, we found an error this year, in the subsequent year, from an error that happened 2-3 years ago, we have to go back and do a prior period adjustment, and we have to restate that income statement. Next subject, earnings per share, which I talked about before, how important it is. And basic earnings per share and diluted are two types. Basic earnings per share is just net income minus preferred stock dividends, because they're not available to common stockholders, divided by the weighted average numbers of shares outstanding. And so we don't, it's whatever the share count is, that's what we use. And that's in contrast to diluted earnings per share, where we still have net income plus preferred shares. And then we're going to add all potential shares that might be out there. What are potential shares? Well, what if the company gave a whole bunch of stock options to executives? Well, they could go exercise those options, and now that suddenly outside of the company's control, there's going to be more shares outstanding. So in diluted, we account for those shares. Another example, companies sell convertible bonds. They sell bonds that are just like regular bonds, and you have to pay interest on them, but the investor has the opportunity, the option to convert these bonds into shares. And therefore they pay less interest because they got that option out there. And so when we do diluted earnings per share, we go assume hypothetically as if the bondholders had converted all those shares. And we do that because we don't want to surprise. If we just did basic earnings per share, there's a lot more shares that could happen if some of these stock options got exercised or these convertible bonds got converted to shares. And so we want to make sure investors can see the real, complete, full picture. So by the way, diluted earnings per share is the one that matters. Diluted earnings per share are the numbers that are quoted in the Wall Street Journal that analysts track, not basic, because it's not real basic, because there could be potentially a lot more shares. And so here's Abbott Laboratories. The other thing I want you to know is both basic and diluted earnings per share. That calculation is done for continuing operations or discontinued operations, and then net income, which is the total continuing and discontinued net income. And so you have all three for basic, and you have all three for diluted. However, and the SEC has been very clear on this, you're not allowed to do cash flow per share, like cash flow from operations per share. It's very clear. These are the only two items you calculate earnings per share for: continuing operations, discontinued operations, and net income. And so you do it for basic EPS and diluted EPS. So financial statements could have 6 earnings per share calculations. All right, comprehensive income. We talked about that. I'm only going to talk about it briefly here. I'm not going to spend a lot of time here, but it are items that under generally accepted accounting principles, there is a change in equity because of these transactions or these circumstances, but we do not let it hit the income statement, because if we did, the people who created these GAAP rules feel like it would be misleading. What kind of things could end up there? Unrealized gains and losses on investments. We'll cover that in 3120. Pension plans. They are massive changes in the liability for pension plans, which we want to make sure we reflect on the balance sheet. But sometimes they're so massive, and the pension plans are a long-term deal. They may not pay out this liability for 30, 40, 50 years, when as employees retire and get paid out. And so we don't want to have all this volatility in the income statement. So we put it in a bucket in other comprehensive income. And another big one that you'll see, foreign currency translation adjustment. So in advanced accounting, you will translate all the balance sheets and income statements around the world in whatever currency, you'll translate them into US dollars. And you're going to have this really big, it's kind of a plug. You got to do something with it. Again, it wouldn't be right to hit the income statement with that, because until you sell that business, you don't really recognize a gain or loss from the change in the currency since you bought that business. And so we let this end up in the bucket, if I will, other comprehensive income. Let's get by this one. And so inside equity, now, when we talk about other comprehensive income, that's what happened this year. These are these changes that I referred to, foreign currency translation, that happened in this year. And we do have a statement. This just came out in the last 5 to 7 years, maybe 10 years now. FASB requires you to do a statement of comprehensive income that starts with net income, and here's all these other changes. So you see one line item, comprehensive income. And the FASB did this because they were concerned investors were missing some of these other items because they're not on the income statement. Now, I've sat in a lot of investor calls for the 2 public companies I work for, and I've never heard one of the Wall Street analysts ask a question about comprehensive income. However, they ask a lot of questions about net income and gross profit and operating profit and segment profit. I've never heard one question about comprehensive income. However, it is a statement. You need to know it as accountants. Now, what happens to this comprehensive income? Like retained earnings, in the equity section, there's a section called accumulated other comprehensive income. So it's just like retained earnings, that it captures all the comprehensive income recorded over time, excluding net income, which goes to retained earnings, and it places it in equity. And it's a component of shareholders' equity called, I like it for AOCI. That's how you refer to AOCI. Again, inside the equity. All right, we're nearing the end now of this entire lecture. And so the final section is around the statement of cash flows. And boy, it's my favorite section because it tells another aspect of the story. Let me use this example. Maybe because we do all this accrual accounting, which is great, I believe in accrual accounting, but you could have very profitable company, very high net income, big revenues, low cost of goods sold, high gross margins, and they're doing great. However, what if they were not collecting their accounts receivable? They were debiting accounts receivable and crediting revenues, so revenues are big, but they got this accounts receivable balance that's growing. Why? Customers aren't paying for it, paying them back. Maybe they have bad customers. Maybe they have bad products that customers are refusing to pay for. Whatever reason, accounts receivable is growing. Therefore, net income does not reflect cash received. And if you just look at the income statement, you can see that on the balance sheet maybe, because you see accounts receivables growing, but you don't see everything. So you would see it clearly in the statement of cash flows. In my example, you would have potentially a much lower cash flow from operations than net income. And that could kind of point to problems. And so cash flow from operating activities is a very important metric. Now, what I would say about this statement is it takes all the cash flows in and then all the cash flows out, and it divides it into 3 categories: operating, investing, and financing. And I think we're going to get into this. So operating activities, that's what you would think. It's called all the cash inflows and outflows related to running our business, right? And so, by the way, all those changes in working capital, current assets and current liabilities, those changes flow into the operating activities. And so net cash from operating activities, you want that to be a big positive number. And there are two methods of doing the cash flow from operations. The direct method is capturing all the cash in and cash out. Sounds really good in theory. And the SEC and the FASB, they encourage you, all companies, to use a direct method. And they're very clear about it. That is the preferred method. Okay, here's the one area of rebellion. Nobody does it. Everybody uses the indirect method. You get the same answer in both, but the indirect method is so much easier for companies because we start with net income, which we calculated. We have all kind of processes and controls to make sure it's accurate. And we just do changes in working capital balances to get to cash flow from operations. For example, if you had, let's go back to my example, where you had a big increase in accounts receivable because customers were not collecting cash. I start with net income, but I'm gonna have a big minus because my accounts receivable grew. And so that's how that worked. At the end of 3120 at UNT, I'm going, if you're if I'm your teacher, you will be doing cash flow statements because it's so important to know how to do a cash flow statement. So I'm not going to make you do it here in this chapter, but you do need to understand the indirect method and how that works. And so you see this example of Arlington Lawn Care. They started with 45,000 in net income. They added back depreciation expense. Why? That was an expense that reduced net income, but it didn't require any cash. So we add that back. The non-cash expense gets added back. And then we have all the changes in our working capital. And then here in this case, net cash flows from operating activities were 49,000. They were positive and they were higher even than net income. That's kind of another little like bit of information that tells me maybe they're doing a good job on their accounting because their net income and their cash flow from operations are close to being the same. Investing activities are what you would think. It's cash inflows or outflows related to their investments. You know, the biggest one is always going to be property, plant, and equipment. So if a company is buying lots of property, plant, and equipment, you know, maybe building a new factory. If it's a restaurant business like Brinker here in Dallas, they're building more Chili's around. They're investing. And so those cash outlays are included in investing activities. And what is this? Now, they could be selling assets off too, and so you could have cash inflows. So I don't want to forget that. But you know, why does it matter? Why do I care so much about this line item? All right, telling the story. You know, let's say a company has great income, really high positive cash flow from operations, but this line item is zero. They're not investing in the future. Well, man, is their growth sustainable? Is their income going to go up? I don't know. Let's compare and contrast that to a company with really good, solid income, and yet they're investing, got a big negative number here, big use of cash. They're buying more, they're building more restaurants, building more factories. Well, they made money with their current operations. I bet they're going to make even more money as they add to those current operations and run new restaurants, new business, whatever their business is in. And so you want this to be a big negative number. That tells you the company might be growing in the future. They might have higher net income in the future, higher cash flows. Just think about it. And I talk to my students more as future employees, right? If you want to go work for a company that is selling everything off and declining, or do you want to work for a growing company? Because if the company's growing, there's going to be a lot more opportunities for you. There's going to be a lot more money for salary increases. They need good leaders, right? So you learn how to be a leader. And so you can grow with the company. And so look for negative numbers. You never say negative numbers for financial statements. Mostly Here you want a negative number. Cash flow from operations, you want it to be positive. You want this to be negative, that they're investing, using cash for the future. And finally, finance activities, where are they pulling in money from? How, but maybe they can't, cash flow from operations are not enough to fund the future. They go out and borrow money. And that's where you would see this in financing. By the way, dividends, which are payments back to owners, not expenses. They're not part of operating the business. Dividends are payments to owners, and they show up here in the financing activities. And I'm going to skip by that example. And we finally end here with the different ratios, activity ratios, or asset turnover, net sales divided by total assets. You want this to be a really high number, that they're generating a lot of revenues from their assets. Receivables turnover, net sales divided by average receivables. Again, you want that to be a high number, that they are collecting. That would tell you that they're collecting their receivables. Inventory turnover ratio, you want them to be turning their inventory, that the inventory is not sitting around stale. And so you want that to be a high number as well. You can take these activity ratios. Let's look at net sales divided by accounts receivable. Now I can take that 365 divided by that turnover. Now I can understand, what is their average collection period? Let's just do one, for example. Let's say net sales was 6 times accounts receivable. So 6 net sales divided by accounts receivable was 6.0. Then if I come over here, 365 divided by 6, that's about 60. That would tell me that the average collection period for accounts receivable is about 60 days. So their terms must be around 60 days. Now, if you came up and you found this to be like 180 days, and we know most receivable terms are 30, 60, 90, telling the story, why are they not collecting their receivables? Why they have 180 days worth of receivables there? That gives me some pause about whatever company they might be. And you can do the same thing with the inventory turnover ratio. Again, if you have, if you have just 60 days of inventory on hand when you calculate this, that might feel pretty good. If you've got, and you could have this, 2 years worth of inventory, that tells you, hey, the inventory's not selling. Even if it's 10 months worth of inventory, what's going on? Is this inventory good? Maybe they produced a whole bunch of products that they cannot sell. Oh, yeah. See how these ratios can tell you a real story. Profitability ratios are also just really important and used. Profit margin on sales, whenever it is a net income divided by net sales, return on that. Whenever you see these words return, usually the return means net income. Net income divided by average total assets. Return on equity. This is a really big number. It has been proven to correlate to high stock prices. When you have a very high percent of high income divided by your shareholders' equity. So there's a lot of useful information you can get from calculating these ratios right from the income statement and the balance sheet. With that, that is the end of chapter 4. I hope you found this useful. And if you are in my face-to-face class, I look forward to seeing you. And again, thank you for everyone who has looked at this video online. And have a great afternoon, morning, evening, wherever you are. Thank you.